What's up guys, Jake here. In this video, I want to do something a little bit different. Normally, I try to teach you guys something useful information, actionable information that you can take to your own personal life for finance and investing. But in this video, I want to get your opinion on something. I've had this crazy idea in my head for about 2 or 3 months, and I'm looking for your input. Now, hear me out all the way through before you leave a comment that I'm an idiot and this is dangerous and I'm gonna blow up my account. I am legitimately asking for the math of where is my mistake? What am I missing here? And the question that I'm posing to you is it possible to never lose money in the stock market? Now, the cheat answer to this is yes, just buy and hold forever. You only lose money when you sell at a loss. So if you invest in a very safe asset like an S&P 500 index fund for a time period of greater than 20 years, then yes, you should not have lost any money. But I want to accelerate that. What can I do on a shorter time scale, a week, a day, a month, in order to never lose money in the stock market? And the more I've learned about especially options this last year, there are 6 tools available to me as a trader, as an investor, and 95% of people only do the first one. They buy stock. As soon as they don't want to hold that stock anymore, they sell it, but they're ignoring the other 5 tools. If your assumption is the stock market will go up, you can buy a call, you can sell a put. If your assumption is the stock market will go down, you can short sell the stock, or you can sell a call, or you can buy a put. I've been staring at these 6 tools available to me and saying, somebody smarter than me has already figured it out. An infinite money glitch in the market where whether the market goes up or down, they never lose money. So let me run my idea past you, and I want to get your opinion. But to understand what I'm going to be talking about in this video, you really do need to understand index funds, ETFs, margin, and trading options. Now, I think everybody understands what an index fund is. An ETF basically is an index fund that acts like a stock. It can be bought and sold in real time on the New York Stock Exchange. Margin is just the ability to borrow money from your broker, and usually it's a 7% annual percent rate. So, if you're only borrowing money for a short period of time, it's actually a very small amount of money. So normally financial advisors will say never use margin, avoid margin. People can get into trouble using margin, but it's nothing to fear if you use it responsibly. And then finally, trading options. And trading options is its own world, really. You're going to have to watch some of my videos. I made a playlist to understand trading options. Otherwise, you'll have no clue what I'm talking about in this video. I have a playlist here with 23 videos. Check out this first one where I titled it, The Best Explanation of Options Trading. Obviously, I'm a little bit biased, but if you don't understand what a call option is, then this idea won't make sense to you. But before we can get to the idea, I have to first tell you about my history with casinos. About 15 years ago, when I was an undergrad, at this point, everybody was getting into online poker, Texas Hold'em, with websites like PokerStars and Full Tilt Poker. So I had an interest, and I would play casual online or with my friends. Additionally, when I went to Korea, I visited some casinos and I took a trip to Macau, and everyone in Asia plays Baccarat. If you ever want a very simple table game that you can't really be bad at, play Baccarat. You're basically betting on a coin flip. However, blackjack is something I got into because I'm a math nerd. I read the book Bringing Down the House, the inside story of 6 MIT students who won millions in Vegas. They made a movie about it called 21 with Kevin Spacey and Lawrence Fishburne. So I got into it. I got into card counting and various betting strategies to say, is it possible to make a good return doing this? And what I learned after several nights in a casino is I hate casinos. It takes a lot of time, there's a lot of risk, and I just don't think casinos are very fun. Sitting at that table, hurting my brain, surrounded by all the lights, the noises, the creepy people. Many casinos still have smoking, and It just wasn't a fun experience, and I didn't feel like the return on my time made it worth it. But while studying blackjack, I did investigate several betting strategies, and the most well-known of all of them is the Martingale betting strategy. If you know what the Martingale betting strategy at this point in the video, you might be saying, this guy is an idiot, he's going to lose everything. But just hear me out. And if you don't know what the Martingale betting strategy is, I can explain it very simply. It's very easy to understand. Let's say you sit down at a baccarat table, a roulette table, or a blackjack table. There's going to be a table minimum and a table maximum bet. And the reason why there is a table maximum bet is because of the Martingale betting strategy. So let's say the table minimum is $10 and you play a hand of blackjack. And if you win, you take your $10 in profits and you reset to the minimum bet, $10. But what if you lose? If you lose, then you double up. You bet $20. You need to recoup the 10 you just lost, and you're still trying to win 10 from your original hand. You always want to be winning. So if you win, then you just reset. You go back to the minimum bet, $10. You take that 20 off the table, recovering the 10 you lost, and making the 10 profit that you should have made on the first hand. But what happens if you keep losing? Let's say you bet 10, you lose, you double up. You bet 20, you lose, you double up. You bet 40, you lose, double up. You bet 80, you lose, you double up. You then go to 160 and you lose again. Oh no, sorry, thank you for playing. You've hit the table maximum bet. The next degree, or the next double up, should have taken you to 320. Now you can bet 300, hoping you win, and then you're only down 20. But it doesn't matter. Casinos don't fear the Martingale betting strategy because it is a losing strategy. Whether it's roulette, blackjack, craps, baccarat, the strategy can never win you money because the house always has a 51% advantage. The Martingale betting strategy relies on very small incremental gains. You're only winning, in my example, $10 at a time. However, if you lose 5 times, 6 times, 7 times in a row, it doesn't matter how many hands you won of $10, your one massive loss will completely wipe you out. But the New York Stock Exchange is not a random sequence of events. What happens in the market today is directly correlated to what happened yesterday, and what happens in the market today will directly affect what happens tomorrow. We might not be able to predict the future or understand what's happening on the New York Stock Exchange, but it's not random. Monetary policy, investor sentiment, there are lots of factors going into it, but it's all interconnected and related. For a roulette table, dice, or cards, it is completely unrelated. Dice, cards, and a roulette table do not have a memory, especially with cards if it's a continuous shuffling machine. What happens this hand has no impact on the next game or hand. So all events are truly random. So the probability of 6 wins in a row is equally likely as 6 losses, or win-loss, 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 if it is a 50-50 probability. But it's not. The house has a 51-49 advantage in the most common popular games. But when we look at the stock market, who has the advantage? If you buy and hold, for example, an index fund long-term, 30 years, you're going to be doing pretty well. This is the S&P 500. If you just bought and hold for 30 years, you're winning. So what would you do if there was a game at a casino in which the player had an advantage, maybe a 10% advantage over the house? What could you do to basically guarantee yourself money? With that understood, let's now introduce my idea. And first we need to pick an index fund in order to trade on. We don't want to do individual stocks because individual stocks are too volatile and risky by themselves. We want a nice, broad, stable, predictable index fund. So let's go with the S&P 500, and the largest traded S&P 500 ETF is State Street's SPDR S&P ETF, ticker symbol SPY. There are other ETFs that you could run this strategy on: Vanguard's VOO VII, BlackRock's IVV, Invesco's QQQ, that is the NASDAQ. But State Street's SPY is not only the most traded the most options traded ETF, it's traded with options more than any individual stock either. What that means is you'll get lots of volume and liquidity on trades. The bid-ask spread will always be very tight, so you're getting good prices, and you don't have to worry about not being able to sell contracts if you want to get out of them. So let's go through the strategy, and step one is to buy shares of SPY, as many as you can afford. Ideally, you want to get to 100, because if you can get to 100, you can start selling covered calls. Now, the SPY ETF tries to mirror the S&P 500. So let's look at the S&P 500 value, which is 4,204. SPY is 420. So you see what they did there. They're trying to mirror the dollar amount for SPY to the value of the S&P 500. So to buy 100 shares of SPY, this is expensive. It's $42,000. So if you want to pick a different ETF, you're not going to get as much liquidity and volume on options contracts, but you can get 100 shares for a lower price. But you don't actually need 100 shares. 100 shares is just a bonus because you can start selling covered calls. So sell a covered call if you can to collect premium. Now, what happens on a red day if the market goes down? And if the market goes down, then you want to buy to close your covered call for any profit that you can get it. You're then going to start selling off some of your shares. And remember, it went down, the market went down. So you're going to sell off shares of SPY to open your first call contract. You're betting that the next day the market is going to be green. And this is when you're going to start building your SPY ladder with degrees of call contracts. Now, there's lots of different ways you can do this, and depending on the time period, the expiration date, you can lower the amount this would cost you. But I'm being pretty conservative here, and I'm going to have the first call contract be at the money with an expiration of 10 months from now. Now, the Black-Scholes formula determines an option's price, so I'm going to make a bunch of simplifications in this video in order to make this understandable. But just know that there's a lot happening here, and I'm being oversimplified with these prices. So let's look at the option chain for SPY with an expiration date in 10 months. So this is March of 2022. And we're going to get the closest at the money call contract. Remember, this is right after a theoretical red day. So the mid price is 2,360. So that is the first call contract that we're going to buy on the first red day. Now, if tomorrow, the next day is green, is positive, then sell your call contract, sell to close it for profits. You're deleveraging and you're going to repurchase your shares of SPY. You're basically resetting the board in order to get back 100% into the ETF. And remember, holding the ETF is pretty good. The long-term average of the S&P 500 index fund is about 10% a year. So if the market is green on any given day, you're still earning off of however many shares of SPY you have. But if there's a red day, then you start leveraging your money by buying call contracts to basically recoup money you lost from your shares of SPY going down. But what if the market keeps going down? We have consecutive red days. Let's investigate this. So if you had a red day and you bought your first call contract, then the next day is red again. At this point, you're going to buy 2 call contracts, once again at the money, but this time I'm going to choose a closer expiration date, so it's a cheaper premium. So just looking at the option chain, once again, this isn't accurate because the share price of SPY would have gone down 2 consecutive days. But we'll just oversimplify it and use the value for the current option chain for January of 2020. This is 8 months from now. And the premium I would be paying is $4,100. So what I'm doing is basically the Martingale betting strategy, where if the market is red one day, I leverage my money, I sell shares of SPY to buy a call contract to recover what I lost from my shares the day before. And if it's red 2 consecutive days, then I double up. I buy 2 call contracts, hoping the next day will be green. What's happening here is 1 call contract will recover the losses from the first one and the losses from the SPY shares. Now, unlike the Martingale betting strategy, you haven't lost any money on this contract until you sell it for a loss. You know, if you bet $10 at a blackjack table, that $10 is gone forever. However, when there's a green day in the market, this contract actually earns back a little bit of value. So when there's a green day, you have 3 call contracts that are green to help you get out of a negative position. Likewise, if there is a 3rd red day, then you buy 4 call contracts. If the next day is green, you have 7 call contracts that are all going to be gaining in value. So this will help you get to a net positive position amongst all your contracts. So that first one might still be red, however, you don't care. You're going to sell all 7 to deleverage and take a very small profit. If there's 4 red days, I buy 8 call contracts. If there's 5 red days, I buy 16. If there's 6 red days, I buy 32. And you'll notice the expiration date is decreasing. I'm doing this for 2 reasons. If the market is declining, then there's less time I would need to recover in a worst case scenario. But also I'm getting a cheaper price for the premium of these contracts as you're not paying for as much extrinsic value. Now the Greek, if you're not familiar with Greeks, I made a video about this, but the least important Greek that nobody pays attention to is gamma. And gamma actually helps you out when you buy call contracts in a decreasing time period. The reason why is because gamma is the rate of change of delta for every $1 move in share price. What does that mean? That means that when the market goes back up, let's say you got to level 5 or level 6, you're actually earning more money than you had originally lost on the 10-month. Because gamma shrinks the closer you get to expiration, delta gets bigger for moves in the share price in the short term when you're closer to expiration. So when you buy 16 or 32 at the money call contracts and then the market shoots up 2%, you're actually earning more intrinsic value than you lost when these farther out expiration contracts went down 2%. So this actually helps you make even more money should you get to level 5 or level 6. Total, how much is this going to cost you? Just using the option chains today when SPY is at $420 a share. Total cost, $48,236. This is a oversimplification because if the market has gone red for 6 days in a row, the market's potentially dropped 30%. So implied volatility would increase, causing the contracts to be more expensive, but the share price movements would drop it by a greater amount. So these dollar amounts for level 4, 5, and 6 would actually be much lower. Now, if you're watching this video and you're saying, Jake, you're nuts, $48,000 is way too much. Once again, you can do this on a different ETF. Invesco's QQQ, the share price is only in the 300s. Vanguard's VTI is only in the 200s. So if this crazy idea is something you're interested in, you can do it on a cheaper ETF. So the basic idea is if the market is negative, double the amount of call contracts you have. And if the market is positive, sell all the call contracts. You're viewing all the call contracts you have as basically one position. And you sell it as soon as you can for a profit. You deleverage, you reset, you repurchase your shares of SPY. So how often are there 6 or 7 consecutive red days? When you look at the S&P or SPY over the last year, and the last year has been pretty green, the most we've seen is 3 consecutive red days. Here's a 4, here's a 3, here's a 3, here's a 3, here's a 3. So let's look at historical events. Let's go back in time and we'll look at the two worst events of the last 20 years. So here is the pandemic crash, and we're looking at a time window of February 1st to July 1st of 2020. So how many red bars do we have down here? 1, 2, 3, 4, 5, 6. So if you had been doing this strategy, you would have been fully leveraged, maxed out right here. And there would have been a 7th red day. It would have gone down one more time. But if you held, there was a pullback, a snapback, a dead cat bounce, whatever you want to call it, in the market the next day. This green day, where the market went from 291 to about 310, that would have been enough to recoup all of your losses and get out of the total position for a net positive from all of these 6 red days. Pretty intense. Now, when you reset the board, you then had 1, 2, 3 consecutive red days. However, a green day would have gotten you out of it for a profit. 1, 2 consecutive red days, green day would have gotten you out of it. Red day, green, red, 2 reds, and then a green would have gotten you out of it. So you would not have lost money doing this during the 2020 pandemic collapse of the market, in which the market went down by 30%. Let's now look at the other great financial collapse of the last 20 years, and this was the 2008 housing crisis. So this time period is from September 1st, 2008 to April 1st, 2009. And we had 1, 2, 3, 4, 5, 6, 7 consecutive red days. So you would have maxed out here. There would have been a slight red day here, and then a huge green day here. So you would have had close to 64 1 month, 64 call contracts, 32 being 1 month, when the market snapped back 10% on this one day. So that would have given you a huge profit, actually. You would have made a lot of money if you had done this. Then there was 1, 2 consecutive red days, a green day, red day, a green day, 1, 2, green day, 1, 2, snap back, green day. The market just does this. When you have a red day, the probability of a green day preceding it increases. There's always these pullbacks where people think, oh, the market has bottomed out, this is the perfect time to buy. There's also just people who like, large fund managers who like manipulating the market in that they buy a lot green one day, so other investors who only trade during the day buy back in. They then sell out in aftermarket or pre-market hours to basically have the other people be the bag holders. So there's lots you can do with this strategy, and I think it's really interesting. So what are the risks of this strategy? And first, you need to have nerves of steel. You need to develop a game plan and then not deviate from it. You know, when you're listening to the news and it's all doom and gloom, it's easy to make an emotional decision, and you can't do that. So the risk is the market will go down and then never have a snapback, never have a dead cat bounce. And that just isn't how the market operates. It's not a random sequence of events. The other risk is the government collapses and the whole stock market goes to zero. If that happens, it doesn't really matter if you're holding SPY as an ETF or SPY as call options. If it's all going down, it's all going down. So I don't even consider that a risk, really. If you're in the market at all, then that's not a risk. But what are the benefits of this strategy? And the first one is I only have to pay attention to one stock, one ETF, SPY, and it's the market average, which helps you because there's always this reversion to the mean. You know, there might be periods where the market overall is overbought or oversold. And whatever the true value is, the market has a way of reverting to the average, to the mean. And you can use this to your advantage in this call purchasing strategy. So what can I earn from this? And like the Martingale betting strategy, it's very small gains day to day. So every day the market is green, I should be netting a profit of between $50 and $100. And that might just be for the call contracts, not for the shares of SPY. You can still be careful with ex-dividend dates to make sure that you're collecting the dividends on SPY. And you're still getting the normal share appreciation of whatever the S&P 500 increases over time. In addition to anytime you have a red day, you follow it by a green day, you try and make a net profit of between $50 and $100. Pretty interesting. And I'm not saying this all as a theoretical. I've actually started doing this in my Fidelity account. I've got about $70,000 in my Fidelity account, and I've purchased 200 shares of SPY. And this means the value of 200 shares of SPY is $84,000. So I'm on margin, costing me 6 or 7% annual percent yield. It's a very small number, guys. And I'm on margin $14,000, and I've sold 2 call contracts, covered calls, against my 200 shares. So if SPY trades sideways or slowly goes up before these covered calls expire, I'm making $604 just this month from the call contracts. Additionally, since the market right now is at all-time highs, and I think there's going to be a pullback or a dip soon, I went ahead and bought a put against SPY. If the market's at all-time highs, why not? You know, if you're expecting a panic sell, freak out, pullback at some point in the next 2 weeks, I might as well try and make money off of that. So I purchased a put. You don't have to do this. This is just something extra that I'm doing. So I don't even actually have to get rid of this covered call or sell these shares of SPY if I have margin. For the first call, if there's a red day, the first call contract, I'll just use margin to get that set up, and then if it looks like I don't have enough margin buying power, then I can buy to close my covered calls because the market's already gone down 3 days in a row. I can sell for a profit my puts, and then I can sell off some of my shares to start buying call contracts in order to cash in on the snapback, the dead cat bounce, whatever you want to call it. So per day, you know, I'm trying to earn, because I have two cohorts of this. I'm not just running it on 100 shares. I'm doing it on 200 shares. So the first red day, I'm going to be buying 2 call contracts. If it got to level 6, then I would be buying 64 1-month call contracts. I don't think it'll get there, but maybe. So I'm trying to make between $100, $200, or $300 every day the market is open, and I'm doing pretty good at it. Okay guys, that's the idea. If you want to call me an idiot, go ahead and let me know in a comment down below. And if there's anything about the math as far as trading options that you know that I didn't cover, that I'm not considering why this doesn't work, let me know in a comment down below. I would really like to hear from you guys. If you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, check out that playlist on trading options. It will help you out immensely if you have no clue what I'm talking about. Till the next video, take care.